Our next example is going to be around long-term assets, specifically buying them with cash. Remember, long-term assets are anything like buildings, machines, cars, all that kind of good stuff. Now, let's say, for example, you're going to buy a machine for $100,000. Now, that machine is going to be a long-term asset, and that's going to go on the balance sheet under assets, and it's going to increase assets by $100,000. At the same time, cash, since we're going to say that you paid in cash this time, is going to go down by $100,000. So assets up by 100, asset down by 100. Equation works. Assets still equal liability plus equity. However, you cannot forget about depreciation and its impact on both the balance sheet and the income statement with long-term assets. The way we calculate depreciation is we look at the total amount of life of that asset that you just bought. So let's say that 100,000 piece of machinery that we just purchased is going to be lasting us about 10 years. So we do 100,000 divided by 10, and we end up seeing that it's going to cost us $10,000 a year in depreciation. So that depreciation number hits us in two different ways. The first way is on the balance sheet, under accumulated depreciation. You see, accumulated depreciation, which is tied to long-term assets, goes up by $10,000. However, you have to remember, accumulated depreciation is a contra account. That means that assets actually fall by $10,000 when it increases. Now, at the same time, since assets have fallen, something else also has to fall for our equation to remain the same. So, where else does depreciation work? It also touches the income statement as depreciation expense. And remember, we start with sales, we take away all the costs and the expenses, and we eventually get down to profit. So if expenses increase, then profit decreases by that amount. So we'll see that it actually decreases profits by that $10,000 too. Now, profits eventually turn into retained earnings, which is something we talked about a little bit ago. You see, retained earnings is the other part of the equity account that is not stock. So it ends up working out perfectly. You see, accumulated depreciation goes up by $10,000, which decreases assets by $10,000. In order for assets to equal liabilities plus equities, something else has to be decreased by $10,000. Since depreciation expense decreases profits, and profits turn into retained earnings by that same $10,000 amount, that means that equity, retained earnings, decreases by $10,000 as well. And there, once again, we have assets equals liabilities plus equities. Now, of course, let's not forget about the cash flow statement. Now, as we've all spoken about, depreciation is a non-cash event. You actually aren't paying $10,000 a year to use this machine. However, you did pay $100,000 the very first time you bought it. Accumulated depreciation and depreciation expense will not affect the cash flow statement at all. You're actually going to add that back into net income whenever you look at cash flows from operations. However, your original $100,000 purchase of that machinery is actually going to go into cash from investing. And in this case, it's going to decrease cash from investing because you spent $100,000. Remember, on the cash flow statement, cash from investing or cash to investing, it can be written either way, is all about long-term assets. So buying a piece of machinery is always going to affect that account some way, somehow.